Welcome everyone to Fundamentals Unfiltered. I'm your host Matt with the Fundamental Investing Institute. Today is Tuesday, August 19th in the wonderful year of 2025. So within the past week, the Consumer Price Index came out. It rose 2.7%, and that is for the previous 12 months, ending in July. It's reported by the Labor Department, and this is slightly less than the 2.8% that economists had expected. Core inflation, which excludes food and energy prices, rose by 3.1% for the last 12 months. And this has gotten people talking or gotten markets believing that a rate cut in September is going to be more imminent. 2 days after the CPI came out, the producer price index came out, and this came in at higher than expected at 3.3% for the previous 12 months. And it is indicating that higher costs are being absorbed by American businesses rather than being fully passed on to consumers, at least for the moment. I don't know. It's probably too much to ask that politicians do not sell their policies as free lunches, but that seems to be the case. That's not going to go away. Anyway, my plan for today's show was to kind of do a deep dive into the monetary frameworks and the fiscal policies that came out over the last 5 or 6 years, and talk about how these things contributed to the inflation that we saw in 2021, 22. I changed gears, and the reason is I came across an article on CNBC.com yesterday. So I'm going to do kind of this deep dive into inflation on another show, but I came across this article on CNBC.com, and it's talking about, let's see the name of the article. When Invest Like the 1% Fails, How YieldStreet's Real Estate Bets Left Customers with Massive Losses. Now, for those who don't know, back in 2012, there was legislation passed called the Jobs Act, the Jumpstart Our Business Startups Act. And what that legislation was really meant for was to help small businesses raise capital over the internet, advertise it. But there were a whole lot of things with current securities laws that precluded them from doing so. So the Jobs Act passed, and it directed the Securities and Exchange Commission to modify existing security laws to allow this to happen. So the Jobs Act created a couple of channels for companies to do this, but one of the consequences of the Jobs Act is you had investment portals, what you might call fintech or financial technology portals, pop up that helped individual investors invest in private markets. And YieldStreet was one of the better known ones. I think YieldStreet came up in 2015. There are a couple of other ones, and I can't say that I knew YieldStreet other than through its reputation. I spent a little bit of time on the website yesterday when I came across this article, but basically a lot of their real estate bets are souring, and it's leaving a lot of individual investors with some big losses. Some of the investors profiled are facing hundreds of thousands of dollars of losses in these real estate bets. And for individual investors, that's a big hit. It's taking a big chunk of their investable assets. Now, I don't know if these investors or these offerings were so-called accredited, meaning higher net worth. My guess is, just given the size of the losses, that they were, because the Jobs Act does create some channels for non-accredited investors. But given the size of the losses, given the size of what they were investing, my guess is that these were relatively higher net worth individuals. But nevertheless, this platform, it hosts different types of offerings, but this platform had a lot of these pretty big real estate offerings come up. And of course, when interest rates reset, and it was one of the biggest interest rate resets in modern times that occurred in 2022 and 2023, a lot of real estate bets went sour. And I think about my own experience in this field at the time. I was talking to a lot of real estate operators, um, really back in the 2019 2020 era, and they were really taking, I think, historically low interest rates for granted. So when we looked at real estate deals and we modeled in higher interest rates, every deal that we looked at fell apart. So this wasn't, there's a psychology here with a lot of these private markets, but it wasn't completely out of left field. I mean, it's just a matter of having an appreciation for risk. So what this article is really kind of accusing YieldStreet of is downplaying the risk in a lot of these private deals. The reason it's important is because the president passed an executive order a couple of weeks ago where we're now going to allow people to use their 401ks to invest in private markets of different types. This is something that the private equity industry has been lobbying for some time. The details are not known, so the Labor Department is, which kind of has regulatory jurisdiction over 401ks and other retirement plans. They're going to look into this and put forth rules, and so it's creating a lot of conversation about private markets and the risk of private markets. So I thought this article that came out on CNBC.com was very prescient in highlighting a lot of the risks that we see in private markets. Now, in real estate in general, remember, this was not the point of the Jobs Act. The Jobs Act was to help small businesses raise capital, but real estate operators could use the Jobs Act as a channel for raising capital, because real estate is considered to have a specified business plan. Now, this is kind of interesting. I don't know the political behind the scenes stuff that went on with the Jobs Act. It's something I can look into, but so things like a leverage buyout fund or a hedge fund or something, they could use certain provisions of the Jobs Act to raise capital if all of their investors are so-called accredited, but the other provisions of the Jobs Act, which allowed non-accredited investors to participate, those could not be used by traditional private equity firms like leverage buyout funds and venture capital funds. The companies that used those channels for non-accredited investors had to have a specific business plan. Real estate was thought to have a specific business plan. So I guess if you say, I want to invest in real estate in, the southeastern United States, that's considered a specific business plan. Whereas if you say, I want to acquire a manufacturing company in the southeastern United States, that is not. Again, I don't know the political back and forth as to why that is, but my guess is real estate is generally considered to be lower risk. Now, there are a lot of controls in place and restrictions in place, safeguards, if you want to call them, in place for those non-accredited investors. But for accredited investors, it's sort of buyer beware. Now, that said, I thought it was a good opportunity to talk about some of the risks of investing in private markets, especially that more people are getting in on this. So with real estate, of course, if we're just talking about regular commercial real estate, if you're talking about a mainstream shopping center that's anchored by a grocery store, that's a relatively low risk investment. And because it's low risk, the returns are not great, right? So there's of course a relationship between risk and return. But if you look at more of the real estate development aspect of it, if somebody's building apartment complexes, and I know the market that we're in, apartments are going up left and right, and a lot of these apartment deals have been syndicated, so there's a lot of different investors coming in. There's a lot of things that can go wrong in the development process, and also the nature of the financing has a lot to do with it. So with a lot of these real estate deals, developers rely on, sometimes they rely on variable rate debt, and this is what was happening a lot in the 2019-2020 period. they were using variable rate debt because in the short term, variable rate debt had lower interest costs. So if rates remain low, variable rate debt is often makes a lot of sense because it can increase the cash yield for the investors. The problem, of course, is if you have a strong interest rate reset, your borrowing costs go through the roof, and that's what was killing a lot of deals. Also, slowing down in end user demand. Right? I mean, apartment prices were coming down in certain markets. Office space was being decimated. So a lot of the more speculative deals were blowing up and continue to. Now that said, YieldStreet seemed to have a disproportionately high number, high number of failed deals. And what these platforms are supposed to do is they're supposed to vet the equity sponsor. So they're supposed to be kind of if you're an investor on one of these platforms, you assume that the platform is doing a lot of this due diligence on the equity sponsor. So you have a certain level of confidence in that. Now, of course, the platform can't guarantee that there's no risk. There's a lot of risk in these type of deals, but certainly the platform should do their due diligence. So YieldStreet had, a disproportionately high number of failed deals that came out of this. And one of the there was an investment professional that was interviewed in the article, and he brought up a very good point. When the Jobs Act passed, I thought it was great. I still think it's great. I still believe very strongly in the promise of the Jobs Act. One of the reasons why we started the Fundamental Investing Institute is because the Jobs Act was opening up all of these capital channels for small businesses, and it was opening up a lot of what I think are great investment opportunities for individual investors, and there was a real need for education in this space, and that's one of the key reasons why we started the Fundamental Investing Institute. So I am a big believer in the Jobs Act, but what this investment professional said is with a lot of the deals that are going on these platforms, what you don't know is how many smart, sophisticated institutional investors passed on the deal before they made its way to the platform. In other words, these platforms are possibly getting a disproportionate number of deals that have been looked at and turned down by established institutional investors. So this is a problem economists like to call adverse selection. So there's this major information asymmetry where, of course, the sponsor knows how many people have turned them down, and maybe the platform knows that, but the individual investors do not. Now, another thing that we need to think about with some of these platforms is the compensation structures, both of the platforms and of the sponsors themselves. Of course, the sponsor is just the firm that is raising the equity capital for the deal. But a lot of compensation structures in the investment world, it's sad, but they're sort of a heads I win, tails you lose type of scenario. And so the platform, in taking these fees, they get paid no matter what. And the risk sort of just gets transferred to the individual investors. And when you have sponsors that have bad compensation structures, right, where they're making a lot of money regardless of how the deal turns out, and maybe they don't have a lot of their own equity on the line, you can really get some massively flawed incentives in these private deals. So it reminded me of a platform that went under last year. I think it was called Mainvest. And I remember looking at some investments on this platform probably back in, 21, 22. And it had a lot of promise. Mainvest was, I think it had some real estate, but I think it was primarily geared at helping small businesses raise expansion capital. And I don't know the backstory as to why it went under. I think with COVID, it was just a really challenging capital raising scenario. Of course, it was a challenging capital raising scenario all around, and my guess is that was the nail in the coffin for them. But it was an interesting platform, and I'm still a big believer in using the Jobs Act to help channel capital to small businesses. And even on the real estate end, I've been involved in some private real estate deals too. Most of the deals that we've looked at were too small for institutional investors, and that's where I thought the Jobs Act had a lot of promise. But some of these deals are getting done. They're raising tens of millions in equity capital, and again, you have to wonder why they're going the route of raising money from retail investors as opposed to raising money from institutional investors, real estate private equity funds, or university endowments and those type of things. So my point is there could be some more transparency here. I don't know how this YieldStreet story is going to unfold. They are a strong company with a lot of financial backing, so I would presume that there's going to be some reforms that come out of this. My guess is that that platform is going to stick around, and some of the other platforms are going to stick around, but this is definitely a black eye for the Jobs Act and for private investing. And as I said, it opened up the conversation because there's now this huge capital channel that's open up to private investment firms. And one of the other real risks of private markets, I think one of the more obvious risks, is that these private funds are illiquid. And we're seeing that in the private equity world. Private equity funds are relying a lot on things like continuation funds. The way a continuation fund works is that a private equity fund will say they'll buy a business, they'll do a leveraged buyout, and maybe they can't sell it at a price that makes sense for them, so they will sell it to its own investors in a new fund. And this gives a way for the initial investors to cash out, because of course the way these PE funds work is they have a limited time to put that money to work and to monetize the investment. So there's huge allocations to private markets right now. It's something that we're going to keep our eye on, talk more about in the future, but this is probably going to be the biggest trend for individual investors, is now to see how these markets are opening up. And like anything else, I think investors just need to understand the risks. They tend to get downplayed a little bit. So, especially with the Jobs Act, I don't want to throw the baby out with the bathwater. I'm a big believer in the Jobs Act. I'm a big believer in the potential of the Jobs Act, both to create good investment opportunities for individuals and also to help channel capital to mainstream businesses. So however this story with YieldStreet unfolds, hopefully the Jobs Act comes out of this stronger, and there are better protections for individual investors. But as I say, I think education is the right way forward. I think transparency is the right way forward. So hopefully with this article, some good changes come out of that. I'll just end today's podcast with an editorial that came out a couple of weeks ago from Jason Zweig at the Wall Street Journal. He is, in my opinion, one of the best financial journalists around. Him and Andrew Ross Sorkin are probably the top two names. There are a few other ones, but he titles this Wall Street's Big Bad Idea for Your 401k. So I bring up this article because not everyone thinks that this expansion of investment opportunities in 401ks is necessarily a good thing. I think it could go either way, personally. But Zweig talks about essentially really highlights the illiquidity of these funds, and as we're going to talk about in subsequent podcasts, the big trend in private equity right now is private credit. And I don't know if there's a lot of systemic risk there, but it's a little scary when so much lending is going away from traditional banks, which are heavily regulated, to less regulated areas of the market. Financial history is pretty clear that today's innovation tends to be tomorrow's crisis. So we'll see how everything unfolds, but that's where we want to end it for today. Again, I just want to highlight, as these private markets open up, whether it's through the various investment platforms or whether it's through some of the changes that are coming with 401ks, hopefully investors just keep their eyes open and pay attention to the risks, the unique risks that are involved in investing in private markets. So with that, have a great week, everyone. Remember, focus on the fundamentals. And if you like our content, please like and subscribe to this podcast. And we'll talk to everyone next week.